The theme of this little chat is this question here: where do returns come from? And I don't mean in the generalised sense of you buy ABC stock at 10 and sell it for 15. I want to take a step back and have a look at a more global view of where returns from investments come. Now, little spoiler alert and a little bit of a warning. This sort of presentation comes about because I was bored this afternoon. I had access to Excel and data. So it is rather geeky. And to be honest, it doesn't have any real sort of import for the majority of traders. It might have something for those of you who are long-term ETF traders, but even then I think that's a tenuous link. This is just a question that interested me this afternoon, and it follows on from similar discussions and blog postings I've made over the years on a similar topic. When we look at an index, we have this very, very familiar picture, and this is the All Ordinaries going back to the beginning of 2000. All the data sets I use in this go back to the beginning of the year 2000, so they're consistent across time. And this is very familiar. You can see that historical events you should be familiar with. There's the 2003 bull market that ended in the GFC. The very, very long climb out. A little COVID blip in 2020 where we slipped sharply for a short period of time. And the current downturn in the market. But if I ask the question, what are returns? In broad speak, in broad investor speak, if we're talking about people who are, let's say, portfolio investors, long-term investors, returns equals price plus whatever dividend you get. As a consequence of that, we have indices like this, and this is the All Ordinaries Total Return Index, in that what it does is it folds dividends back into the index to give you a slightly different looking chart. So it takes account of that notion that a return is not only price-based, but also dividend-based. And when we compare the two, when we look at the All Ordinaries versus the All Ordinaries Total Return, they do look a little similar, but they are slightly different in their nuances. You can see that with the Total Return Index, which is the chart on the bottom, the movements seem to be dampened down a little bit. Again, this is the impact of dividends. But before going any further, it's necessary to understand the structure of the Australian market. Our market, like all markets, are broken down into a series of indices. And all I've done here is listed the major breakdown. We have the S&P ASX 20, 50, 100, 200, 300, and the much broader All Ordinaries. Column on the right dictates or says what percentage of the total market capitalisation that this index makes up. And I'm going to return to this later on because it's actually important. But you can see what happens is that the ASX 20, despite containing only 20 stocks, makes up over half the total market cap. And that will become important towards the end of this recording. When we look at returns for stocks, one of the things I always do is I normalise the data by asking the hypothetical question based upon the weekly returns that the instrument or index generates, what would be the trajectory and final value of $1 invested? I find doing that instead of using cumulative returns gives for me a better picture of what the reality of trading is. And you can see here, this is the All Ordinaries Price Index and the All Ordinaries Total Return Index compared. You can see at the beginning, as you would expect, they match one another, they track. But then the compounding effect of folding dividends back in becomes apparent, and you get this ever-widening differential. The trajectory of the two is the same in its broad sense, but the actual price trajectory or movement in terms of returns is quite different. Again, to be expected. One has a higher internal rate of return than the other, so you would expect to see a gap open up. And this holds true even when we look at the smallest component that we are investigating, the S&P ASX 20. You see the same sort of thing. You see they match to begin with, then the differential opens up, with price always lagging. Again, to be expected. So if I come back to this question, it's necessary to look at what actually drives returns for investors. Where do they actually come from? And by that, I don't mean the differential between price and dividend necessarily. I mean, what market segment actually drives a return for a portfolio investor? If we return to these two charts, here's our All Ordinaries, here's the ASX 20. Something interesting pops up when I look at the terminal value of each one. The terminal value of the total return index for both is as follows. The ASX 20 is $5.28. The All Ordinaries is $5.29. That's a 2% difference despite increasing the data set by 480 stocks. You would expect that if the returns from dividends were equal across the entire data set, this differential would be much, much higher because the All Ordinaries would have many, many more stocks paying exceptional dividends. And what is interesting is that when we look at the index, the percentage of the total market cap that index represents, but then the increase in total market cap as a percentage from one to the next, you see something interesting. The way you interpret this chart is, or this table is, the total percentage total market cap for the ASX 20 is 54% of the total market. For the 50, it is 69%. The difference between those two is 27%. And you'll notice that when you double the size of the index, we move from 50 to 100, market cap only moves slightly. You get very small increases. And so what you're seeing is a front-end loading. This, if we were to view this in totality, the statement you would make is that the Australian market is front-loaded in terms of market cap by a handful of stocks. And we see that increasing the size or the number of stocks in the index really doesn't make a dramatic difference in the percentage of total market cap. The differential between the ASX 200 and the All Ordinaries is 300 stocks, but it's 78% versus 85%. So once we move outside of something like the ASX 200, we're not getting much of a contribution. You could even make the point that when you move outside the ASX 20, in terms of market cap, the contribution from each additional stock becomes smaller and smaller and smaller. This lack of increasing contribution tells us something about this next chart. In this next chart, what I've done is I've simply looked at the contribution of dividends and dividends alone. So what I've done is subtracted the price index from the total return index, and this is that differential. And it's the differential for the ASX 20 versus the All Ordinaries. And it's very, very interesting. You could make the statement, based upon seeing this, that the bulk of dividend contribution for investors in Australia comes from simply 20 stocks. Those outside of that make very, very little contribution. Yes, I understand there are about 745 dividend-paying stocks on the ASX out of 2,000 odd. So let's call it a third. Let's say a third of all stocks pay a dividend. The majority have tiny dividend yields. The very high-end dividend payers are confined to the ASX 20 and to a broader degree the ASX 50. So this raises the sort of an accessory question. What value does this have? And outside of sort of the tangential point of saying that people buy the Australian market for the dividends being only partially correct, because it's only partially correct. Because as we've seen, the main source of dividend contribution is a tiny cluster of stocks. It's not the entire market. If you're a dividend-based investor and you're looking for stocks, let's be generous, let's be very generous and say outside the ASX 200, you're wasting your time. You could even be somewhat dogmatic and cynical and say that if you're after yield plays and you're looking outside the ASX 50, you're wasting your time. But in terms of the practicalities for traders, to be honest, I don't think there are any. It's a vaguely interesting topic to people like me, and it may be of interest to people who are looking at building a portfolio around a single ETF. My argument would be that if you're simply after yield plays, you would be better off buying an ASX 20 ETF rather than an ASX 200 ETF. Yes, you may get additional price exposure courtesy of the ASX 200 because there are simply more stocks in there. And you will get some outliers in there that lift the price. But if you're simply looking at a yield play, then your universe is quite limited. And if you're after a single point yield play, then your universe is really, really limited to the ASX 20 or the ASX 50.